Good morning, you're watching Business Plus. Well, it's a news-packed day over the next 25 minutes or so. Let's begin with the headlines. The Zee-Sony merger, the ongoing drama unlikely to end anytime soon. Reports indicating that Sony is likely to walk out of the deal. And it's a fall from grace for BYJU'S, the edtech giant. Its valuation marked down by 86% over 18 months, now valued below $3 billion. And gold is glittering at 62,250 rupees for 10 grams. If you made this investment last year, you would have happily walked away to the bank with a handsome 19% profit. And India's Q2 GDP numbers are likely to be out today. Will RBI's forecast of 6.5% be breached by an uptick as indicated recently by RBI Governor Shaktikanta Das? And COP28 kicks off today. Everything you need to know about COP28 and India's stand coming your way. An ongoing saga in the Indian entertainment space is becoming, in fact, more entertaining than the entertainment content these entities produce. I'm talking about the ZeeSony merger. It's seen the twists and turns of a pot boiler for the last 2 years. Announced in December 2021, the combined entity is slated to be a media powerhouse worth $10 billion. But and there are buts here, but regulatory and leadership challenges have plagued this proposed marriage from the word go. First, it was market regulator SEBI who banned Zee promoter Puneet Goenka from holding a key management position in any listed entity, following charges of diversion of funds between promoter-held companies. The ruling was challenged in the Securities Appellate Tribunal, or SAT, that overruled SEBI's decision in favor of Goenka, and then the Zee-Sony merger was approved by NCLT, the National Company Law Tribunal, on August 10 this year, dismissing objections from various creditors to Zee. In between all of this, there were reports about Sony looking for other partners in India, include Reliance-owned Viacom 18 as well as Adani Group as well as Sun Network. Just as the saga was drawing to a close with a target date of December 21st, 2023, Sony said it needed more time and a March 2024 window could be more likely. And now, in a latest turn of events, a Bloomberg report is suggesting that Sony may just be walking out of the deal on grounds that it does not want Zee's Puneet Goenka, but Sony India's MD and CEO NP Singh to take the top job at the merged entity. Sources at Zee Entertainment, however, have confirmed to News9 this morning that no formal communication from Sony to this effect has yet been received by Zee. And the merger plans continue unabated. In fact, Zee's regulatory filing yesterday also said that it is continuing to engage with Sony to ensure that the merger is implemented. Joining us this morning is Karan Taurani, Senior Vice President at Elara Capital. He joins us to make sense of this development. Hi Karan, good morning. If the merger goes through, what does it mean for India's media and entertainment industry?
Hi, good morning. If the merger goes through, I think it's going to be a very big positive for the India M&E industry. Because what's happening right now is that broadcasting as a business, the growth rates have converged sharply. We have moved downwards from a growth of 12 to 14% about 5-6 years ago to about 4 to 6% right now. So consolidation is the need of the hour. That's one. Consumption on TV has kind of plateaued out. We are seeing lower number of households. We are seeing time spent reducing on TV. And that has also kind of impacted growth rates in some sort of a manner. And the third very big thing is the threat from digital, right? A lot of eyeballs and consumption have moved through digital. Most of these broadcasters also have their own OTT platforms. In fact, all of them have it. But monetizing revenues on OTT or on digital is a far bigger challenge as compared to what it is on the case of TV, because you have too much competition there. The market is fragmented. You have many platforms competing with each other. So I think these are three reasons, in terms of why consolidation is the need of the hour. Otherwise, both companies will struggle to even grow at, 4 or 5% on a medium-term basis.
So, Karan, what are we really talking about here in terms of number of channels, number of OTT applications, and the size, the combined size of the viewership on broadcast as well as OTT that both these individual entities command in isolation right now? And hence, when they were to come together, if at all that does happen, what is the scale that we are talking about in numbers?
So in terms of scale, if you see, both these players have got a large number of channels. They've got channels across various genres. They've got more than 70, 80 channels, put together. And if you look at the numbers, it's taking that, they've got close to 24 to 25% ad revenue market share of the TV business. And if you look at the OTT side, the market share numbers are slightly lower. It's more towards 10 to 12% kind of a number. But I think if you look at both these companies individually, the market share numbers would largely be half, because both companies are largely equal in terms of size as far as TV revenues are concerned. And on OTT, I think Sony Live is a notch above ZEE5 in terms of broader revenue. So I think, by both these businesses coming together, it will be a win-win, because they can kind of, increase their market share put together on the TV business, which is currently at 24, 25% ad revenue market share. You will see better bargaining power in terms of, the content ecosystem by these broadcasters.
Yep.
You will also see some kind of operating efficiency, some kind of cost savings, which will also lead to better profitability for these players. And on the digital side, I think the business is all about scale. And broadcaster-based OTT platforms have not been able to scale up individually because of large competition from MNC giants like Netflix, Amazon, and also Disney Plus, and now JioCinema, which has disrupted the ecosystem. So I think both these platforms coming together will make a win-win proposition as well.
All right. And if, and only if, what reports are indicating right now that Sony walks out of the deal, what happens then individually to Sony, Sony's India ambitions, and to Zee? Is Zee going to survive the onslaught of Sony walking away?
I think it's going to be a challenge for both of them. So it's not either or. I think this deal is equally important for Sony as well, just as it is for Zee. Why I'm saying is that the India M&E industry is going through a lot of disruption, and specifically, with JioCinema offering premium content free of cost over the near term, this environment is going to become even more challenging to compete. Because you've just got, one stream of revenue, which is advertising on the digital side. SVOD revenues right now will not grow much because premium content is being offered free. It's a price-sensitive market. You can't even raise ARPUs. So I think it's going to be a big loss for both of them. I think in terms of Zee, the problem herein is that they are very much focused on the regional genre. They don't have too much of appeal in terms of urban audience.
Right.
And, when the merger was announced, it was clearly stated that both these companies have got very little or no overlap, because Zee is more urban focused as far as TV and digital is concerned. Sony is more urban focused as far as TV and digital is concerned, and Zee is more focused in terms of tier 2 and tier 3 markets. So it was a perfect blend, very little overlap. And both these entities could have become a very big powerhouse and given a lot of tough fight to the top players in the industry. But if the merger falls through, it's a big negative for both of them.
All right. Will they, won't they, is the big question. Karan Taurani, thank you so much for taking time out and speaking to us here at News 9. Well, moving on. BYJU'S, the ill-fated fall from grace of the edtech giant, once valued at $22.5 billion not long ago, just July 2022, has seen multiple challenges plague its existence. Of course, there has been a $1.2 billion Term B loan, which the company does not know how to repay yet, a distressed sale of some of its US-based platforms, including Epic and Great Learning, a change of board, a fall from grace, like I said, and now, in the third round by the same investor, Prosus, the valuation of BYJU'S marked down for the third time, now from once $22.5 billion to under $3 billion. Barnik Chitran Maitra, managing partner of Arthur D. Little India and South Asia, joining us here on News 9. Good morning, Barnik. What do you make of this latest round of Prosus cutting down, slashing really BYJU'S valuation?
Good morning, Karthik. So this doesn't come as a surprise at all. In fact, if you look at the news leading up to this, BYJU'S has partially announced their FY22 numbers, where the standalone entities revenues are around 3,500 crores with a negative EBITDA of 2,300. He had committed last year that they would do around 10,500 to 11,000 on a consolidated basis. So it seems that they have fallen well short of the number once it gets announced. And this is the least of their problems. Right now, BYJU'S is a company in trouble. They're trying to raise money. They have one white knight in Ranjan Pai who's coming and trying to rescue them. There are reports that he has already infused 250 to 300 crores into the parent. But any future capital infusion will be subject to corporate governance, announcement of FY23 audited results, where there was a commitment from the board, which, by the way, now is no longer a multinational board, but just a promoter board with BYJU and his family members, right, to release it by December end. And it is quite likely that they will even miss the December deadline. So I think lots of trouble for BYJU. I think there was an ED notice yesterday as well. That may have been one of the triggers for the markdown. So I think the markdown is expected, but this is the least of BYJU's struggles. I think the major concern is having enough capital to continue as a going concern and not go belly up, which is quite likely given the situation they are in right now.
Barnik, what could really be the problem in the FY23 financials? Because for some reason, there has been delay after delay after delay. As an independent analyst who works so closely with startups, what do you think could really be the issues that BYJU'S does not want to make public, or not make public right now at least?
So first of all, their auditor Deloitte resigned in June or July, right?
Yeah.
Which suggests that BYJU'S has raised money, right? 12 months, nearly 12 months or 15 months back, based on a projection. I suspect that the numbers which will come out will be far lower than the numbers which he has promised his investors. There have been complaints in the past of also how BYJU'S has a tendency to recognize revenue and recognize costs. I think given the increased corporate governance scrutiny, that's also going to have an impact in numbers. I think this is just deferring bad news as much as possible to try to ensure that whatever money comes in comes at a sensible valuation. But I think that major problems remain. There is lack of corporate governance. You have a founder who's effectively on the run. I don't know when he's last been to India to run his company. I think investors, even the white knight, Mr. Pai, is demanding better corporate governance and probably a relinquishing of control from the founder in running the company. So there are many things going on, right? And you mentioned the $1.2 billion term loan, which, by the way, there has to be a line of sight to pay that down. Akash has effectively now been taken control of by Ranjan Pai and with the founder coming back to run the company. So again, the delay could be the numbers are just not there, and it's just going to be even more bad news. And even with the newer numbers, maybe even the $3 billion valuation doesn't seem justified.
All right, $3 billion doesn't seem justified, but just for sake of clarity here, Barnik, a markdown in valuation is not typically a down round. It does not mean that BYJU'S is out there now trying to raise capital at $3 billion of its valuation. It is just Prosus marking down, slashing on its own books, on its own asset side, the value of an asset once valued at $22.5 billion, now valued at $3 billion. Is that right? And what does this really mean for future capital raise from BYJU'S whenever it feels the time is right for it to raise money?
No, so Karthik, you're right. A valuation markdown is not the fact that capital is being raised at this value, but it's a very important guidance to future investors on what existing investors attribute value to, right? I believe it's highly unlikely, given what we've seen, that the next round of capital, when raised, will be anywhere close to the peak of 22 or even close to 5.9 billion as of last year, right? So let's take it as a guidance, right? But I would take it as I would say an honest guidance, because Prosus has been one of the earliest investors into the company. I think till the board member resigned in June, I think they were one of the biggest backers of the ecosystem.
That's right.
The fact that they are marking down, they may be a little bit more conservative, but I don't expect this to be the last markdown happening in BYJU'S, and any future fundraise will be at significantly depressed valuations, right? Nowhere close to the peak.
All right, Barney, before I let you go, just one more question. We also saw, in fact, when Prosus was marking down BYJU'S earlier this year, it had also marked down value of Swiggy and Meesho. And now, in the latest round of news which is coming in from the investor, it is saying that both Swiggy and Meesho are among the better performing companies in its India portfolio. So, are markdowns and markups a regular part of business?
Yeah, it is quite, right? So if you have, it's pretty similar to public markets as well, right? If you have good news, your share price drops. If you have bad news, your share price drops. If you have good news, share price picks up, right? Private markets tend to be a little bit more stickier, means that markups and markdowns are a little bit more conservative. But the investor who has fiduciary responsibility to his investors has to report the right set of results. So if there was a set of numbers and forecasts which did not justify an existing valuation, the investor owes it to their parent and to their LPs to reflect the true value of the company. Now, if the company's turned around, I think, and both these companies have done a lot of work on cost and profitability. Meesho is now the first horizontal e-commerce platform which is profitable. Swiggy has cut costs significantly, right, and is preparing for an IPO. So good news means better valuations. So I think this happens on a day-to-day basis in public markets. It just happens more infrequently in private markets, but it's not surprising given the scale of these companies and the volatility of the market and the business performance.
Right. And Barnik, if Baiju Ravindran was to step down, would it be a decision? I mean, of course, at one point it would be the morally correct thing to do because you have messed up so much. But then would it help in some way turn around the fortunes or the misfortunes of the company as we see it right now?
So it seems right now that he does not enjoy the confidence of his investors, right? If you note today, the promoter and the owners, as of last filing, own around 27% of Think and Learn, a significant portion of which may also be pledged to Ranjan Pai and his group, right? So you do have investors who probably own more than 75% of the company. And if the CEO does not enjoy the confidence of the investors, I think it's better that the CEO figure out a way to transition the business to someone. I think the new India CEO is already quite empowered and running it. But I think the founder should read the tea leaves and do what's in the best interest of the company and also what will be in the best interest of raising future capital into the company.
All right, Barnik Chitran Maitra joining us here on Business Plus. Barnik, thank you so much for taking out time.
Thank you. Take care.
And well, moving on, all that glitters, in fact, all that is glittering right now seems to indeed be gold. Gold prices touched their 6-month high earlier this week, crossing the $2050 per ounce rate. And now, for the first time ever, gold prices in Mumbai breached the 62,000 rupee mark for 10 grams, selling as high as 62,250 rupees for 10 grams. Exactly a year ago, 29th November 2022, gold was selling for 52,500 rupees per 10 grams. It's up almost 19% within a year. Its previous peak was on May 11th this year at 61,500 rupees per 10 grams. Vivek Kumar, economist at Quant Eco, is joining us here on Business Plus. Vivek, is India's fascination with the yellow metal going to cost the economy and going to cost the current account deficit?
Hi, thank you. Good morning, and thank you for having me on the show. So I completely agree with the point that the precious metal prices have been on a run in recent months, and there are various factors behind. So there are global factors as well as few domestic factors which are kind of fueling that run. And we've crossed important thresholds, not just in case of dollar pricing, but also in case of INR pricing for the precious metal itself. Now, as far as the burden on the economy is concerned, I would say that it's still kind of manageable, because if you see the gems and jewelry deficit, so we would like to club all the precious metals together, not just gold, although gold tends to be the predominant share in the gems and jewelry basket. But the overall deficit on account of precious metals imports, net imports, is somewhere close to 14 to 15%. Its share in our trade basket, trade deficit basket. So that's still doable.
I think, Vivek, you've gone on mute accidentally.
In terms of an overall Right. We've been through worse in our past. As of now, we are about 14 to 15%, which is roughly in line with the long-term trend.
Okay.
The long-term trend would be somewhere close to 14 to 15%. So it's still not something which I would be losing my sleep about. But yes, looking at the trade deficit number for the month of October and looking at the sharp jump in gold imports for the month of October, although it was primarily because of festive seasons and a lot of weddings getting combined, we pick up news which do cite that there were a record number of marriages that took place in Delhi recently. So there was festive season, there was marriage season all clubbed together. There was an artificial demand boost for gold. We would hope some of these seasonal factors to go away as we move forward, and they do not really represent a permanent or a structural characteristic at this point.
All right. Well, I just want to bring a little bit of trivia, something that came in from Mr. Nilesh Shah, Prime Minister's, who sits on the Advisory Council of Prime Minister of India and also the Managing Director of Kotak AMC. And he had said recently that had India not imported about $500 billion of gold in the last 21 years, India would have been a $5 trillion economy. Do you concur, Vivek?
Well, it's a counterfactual statement, and there can be many counterfactual statements. If India wouldn't have done this, we could have been here. If India wouldn't have done this, we could have been here. But I think in reality, that's something which is not true. And Indians, like a few other nationalities, for example, Chinese, they have a natural affinity for the precious metals.
All right.
And the reason is that we see precious metal not just as something which helps us in our cultural or religious beliefs, but it also acts as a store of value, as one of the prime source or sources of value, which can be liquidated if need be. So there is a certain degree of safety angle also attached with gold. Of late, I think the investment community will also start. Investment community, not just in case of India, I think globally also there was an inflation scare globally that led to some amount of gold demand.
Right.
Of late, there has been a tremendous amount of geopolitical uncertainty, and that risk rose because of the Russia-Ukraine war,
of course, which
was soon followed by the Israel-Hamas war. So geopolitics is also playing a role. And, just to remind you, the Russia-Ukraine war is very unique because it invited a lot of sanctions against one particular country from across the world. Right. And these sanctions have kind of shaken the belief in the global financial system. So whenever something like this happens, people will tend to store some amount of extra wealth in safe haven assets like gold.
Of course, safe haven assets like gold. And then moving on, Vivek, stay with us. It's a big day today. Q2, India's Q2 GDP growth numbers are likely to come out today. And if history and data from the past is anything to go by, well, Q1 has set the benchmark fairly high. The data for Q1, India's GDP growth in Q1 FY24 on a year-to-year basis came handsomely at 7.8%. There you have it. Ever since the start of COVID, which was financial year 21, we saw negative growth of 5.6% to what was referred to as a K-shaped recovery in FY22 Q1 at 21.6%. Now, long-term estimate for India continues to be in the range of about 7%. RBI saying that 6.5% for FY24 annualized growth and a similar 6.5% growth for Q2 seems like a likely indicator of where the economy would be. But other firms, analysts and research institutions painting a slightly better than RBI picture. ICRA and SBI research saying India's Q2 FY24 GDP could come in at about 7%, while Barclays and Nirmal Bang suggest a more moderate but better than RBI's 6.5% growth expected to come in at 6.8%. Vivek continues to be with us. Vivek, how are you seeing these numbers stack up later today?
So two things here. One is the acceptance that Q1 was really strong, and that you highlighted well that 7.8% was the number. Sequentially, when we move forward from Q1 to Q2, the numbers were expected to look lower and lower. So that is something which is likely to be corroborated by the GDP data release later in the year. Right? Now, having said that, what would be the extent of a so-called normalization? So 7.8 was a pretty strong number. That is something which cannot be sustained in the current state of affairs, and there was a lot of statistical push also behind that number. Now, if the number moderates somewhere close to 6.5%, let's take RBI's forecast as a baseline. In fact, Quantico's forecast also happens to be the same.
All right.
So if that number kind of moderates from 7.8 to 6.5, that is something which is getting corroborated by the fact that things are going to slow down. And we would also see this from the perspective of things are normalizing, because it's not just slowdown from the slowdown perspective. Things are normalizing because 7.8% was clearly not something which was sustainable. If I can take you back even 1 year before that, so Q1 of the previous financial year, we had a 13% GDP growth number.
Right.
Correct. So that was again a lot that had a lot to do with statistical base. So these statistical bases got disrupted because of COVID.
Right.
And slowly every Q1 you'll see these disruptions waning. So these disruptions are waning.
Absolutely.
As we move
That's
forward,
the trend line. You're right, Vivek.
Probably.
That is the trend line. I think Q1 has seen the peaks of 21.6% on account of a low base, in fact, negative growth during COVID. And then Q1 of FY23 at 13.1%, Q1 FY24 at 7.8%. Right. Carry on, Vivek, you were saying.
Correct. So the message is that these disruptions are slowly normalizing. That is one message that I would take from this. The other one is that, let's say if we were to kind of stabilize around 6.5% and RBI's full year growth estimate, I think you also alluded to that, is 6.4%. We are slightly lower than that at 6% with some bit of upside risk. But nevertheless, if I have to take the range of FY24, 23-24 GDP full year growth forecast would be anywhere between 6 to 6.5% if you were to take a poll at this point. Right?
All right.
So that's a reasonable amount of range, and that tells you that things are normalizing after the statistical boost that we received early on in the year. It is also telling you that the record amount of interest rate tightening done by RBI, which essentially means that financial conditions have tightened, and that is likely to have a rollover impact as we move forward. So these two things are the primary. There are few seasonal factors. For example, there is likely to be a minor impact of the monsoon deficiency, not deficiency from a headline perspective, but more so from a spread perspective. And the sowing wasn't really great, although we kind of managed to fulfill the gap to the largest extent possible. But still, there were few gaps here and there in terms of the spread of monsoon. So these are minor factors, but the broad trend line is that there is interest rate tightening, there is financial tightening that is bound to slow down things, and the statistical impact is also waning.
All right, Vivek Kumar there joining us, saying that his projections, or Quant Eco's projections, coming in a little lower than RBI's, looking at Q2 numbers in the range of 6.2% to 6.4%, and annual growth for FY24 also in the range of about 6.2% or so. Vivek Kumar, economist, Quant Eco, thank you so much for joining us today.
Correct myself.
All right, and let's move on for now. Of course, COP28, the world's battle against climate change, kicks off today. What is on agenda at COP28, and what is India's stand? To make sense of all of this, Odisha Srivastav, my colleague at News 9, joins me here this morning. Good morning, Odisha. Take it away. What do we have in store for COP28?
So it's very interesting to note that COP28 summit, it starts today, a power-packed meeting. Delegates from around the world, prime ministers, presidents from around the world will be participating in this meeting. So before we move on to what is the agenda of the meeting, let's look at the host countries from at least from COP21 meeting. The COP21 meeting was held in 2015. So the meeting was held in France, and after that there's a list of countries where the COP meetings was held. the recent COP meeting will be held in Dubai, UAE, and this is the COP28 meeting that we are talking about. Now let's move on to the agenda of this meeting. This meeting has great agendas in place, and number one in the agenda list is taking the global stock take. Now what is global stock take? In the COP15 meeting that we are talking about, COP21 meeting that happened in 2015, there was this term that came across. It was called global stock take. What global stock take means is that the countries will come together every 5 years and they will do an audit in terms of what progress each country has made. So it is a progress assessment which is made towards mitigating the global warming since the 2015 Paris Agreement that we are talking about. And as written, the mitigation that has happened by every country will be, the audit will be taken in every 5 years. Let's move on to which is the next agenda in place. It is about the climate finance. The last COP27 meeting was held in Egypt. Now in this meeting, after a lot of deliberations, a conclusion came across, a breakthrough happened, and it was in the form of establishing a loss and damage fund. Now what was that loss and damage fund? That loss and damage fund was that the developed countries who are developed at this point, for example the US, the UK, these developed countries will come together and they will fund some amount that will be used to mitigate the climate-fueled disasters that are happening in poor and vulnerable nations. Let's talk about the other agenda that is in place. It is about the green energy transitions. The phase out of fossil fuels will likely be discussed again. Now, when we are talking about phase out, it's an important word to consider because in the last COP meetings, India mentioned that we should not be using the word phase out. In fact, we should use the word phase down of fossil fuels. Then there is also the fast tracking of green energy transitions, bringing inclusivity in climate management, and these are some other themes that will be talked about in the COP meeting. Now let's talk about the GHG emissions that are happening in the world and what is the share of India here. So China is at the top, and this is the 2021 data we are talking about. China is at the top with 30%, USA at 11%, India at 7%. Now with India being at 7%, it becomes the third largest country which is emitting the GHG emissions, which makes it even more important for India to be at COP28 meeting and be very assertive in terms of what India wants in terms of climate change and what impact we want from the developed countries to happen for the sake of developing countries. Let's talk about the GHG emissions that are happening sector-wise in India. Sectorally, if we see, electricity and heat are at 1120 million tons, agriculture, manufacturing and construction follows it, transport follows it, buildings and etc. So these are the GHG emissions sectoral wise in India. Now, while this year 2023 was the hottest year on record, there is a lot to be done in the COP28 meeting, and we are expecting some power-packed actions and not just conversations and dialogues, but something concrete to come out of this meeting. In terms of the loss and damage fund that we talked about, developing countries said to the developed countries that they should at least give the developing countries $1,100 billion so that the impact of climate change that is borne by the developing countries can be mitigated.
All right, Risha, thank you so much. What a lovely explanation of COP28 and India's stand, India's greenhouse gases emission. And before we end, well, of course, Finance Minister Nirmala Sitharaman has also said that India is funding its own climate agenda without waiting for the $100 billion fund from the US and from other multinational banks, which is never really on the table. So India is going ahead and funding its own energy transition and its own fight against climate change. Well, with that, we've completely run out of time on this episode of Business Plus. Thank you so much for watching, and World Business Report is going to be back after a short break. Thanks for watching.
Hamas attacks Israel. Israel Defense Forces strike back at Hamas.